Today you will learn everything about trend lines, how to trade them when they're going down, up, left, right, sideways. It doesn't matter. You will know everything about trend lines. We will also discuss a high probability trend line trading strategy that has worked for me for over 10 years. Enjoy. So what are trend lines? To simply put it, they are key levels in a trending market. So why do we draw them? What's the need of a trend line? Well, usually it's to simply predict a continuation move after it touches a key level. Once the candlesticks touch the trend line, usually it will continue in the direction the trend it currently is. And taking trades with the trend will usually lead to high probability trading setups. For example, in a trend line strategy, we will have two different approaches how the trend actually moves. So the first is called a continuation that simply bounces off the key level as we can see on the chart. And the second pattern is the breakout of a trend. So typically there's going to be a trend moving towards the upside or the downside, and we're going to see a solid breakout of a trend. When this happens, typically the trend starts moving in the other direction and starts forming a new trend that you can simply mark up. The trend is now towards the downside, and we can mark every single time it has touched the trend, the market reacted and pushed towards the downside. So now the most common question asked is, how do you actually draw the trend line? Whether you connect the wicks, whether you connect the bodies, most people struggle with this. So to give you a better example, take a look at this. This is NZD Japanese yen 4-hour time frame. It currently looks like a solid uptrend. It's making new highs, it's bouncing off the trend, it's everything you want, plus the bullish engulfing candlestick. But then a couple of hours later, you see this. It kind of breaks your trend and you don't know what to do. What's going on? Why did that happen? Well, if you only looked at a single 4-hour time frame, you don't have the whole picture. That's why if you went to the 1-hour time frame, let's take a look. As we can see, 1-hour time frame, nice little trend over here. So we just moved the trend slightly towards the downside. 1, 2, 3, 4 touches. Every single time the trend was touched, it went towards the upside. The same thing happened over here on the 1-hour time frame. So combining multiple time frames is important. We go back to the 4-hour time frame now. Look what's happening. Of the candlestick wicks, the trend just moves up. Very nice little trend with multiple time frame analysis. So use multiple time frames to understand why the wicks actually happen. Because these wicks on the lower time frames are multiple candlestick movements that happened previously. So you want to utilize as much data as possible for more accurate trend lines. Okay, now let's discuss some trend line high probability trading setups. So first, let's start with the continuation trend line. If we mark it on the charts, clearly it should continue moving up. However, you never know that. That's why you need to go to the 1-hour time frame to use multiple time frame analysis. Now, as we can see, the bottom trend line is totally fine. However, there's trend lines at the top as well. And what we want to do is draw a mini trend line just over here and connect the dots as much as possible. So to me, this would probably do. So we currently have a squeeze pattern in a upwards trend line on the 4-hour time frame. This is what it looks like on the 4-hour, and what we want to do is wait for a solid breakout. Once we get that trend line breakout, take a look at the 4-hour. As we can see, this is a confirmed breakout. We know that there's a lot of buying pressure of these area zones, right? There's things called higher highs and higher lows. This was the previous kind of area of resistance, area of sensitivity. The price was getting squeezed like a little sandwich. So what we wanted to do is wait for a breakout. So we get a breakout over here on the 1-hour time frame. We wait for the same thing on the 4-hour as well. 4-hour is just a great time frame to look for trading entries and opportunities. So we wait for this candlestick closure. This is great. We can open a 2-to-1 to 1-to-1 risk to reward ratio, and let's see what happens. It kind of continues moving up. Some people, and I personally, wait for an exhaustion. What do I mean by exhaustion in trend lines? Well, after the market actually breaks the mini trend line we had over here, after he has a push, breaks out, usually typically it has an exhaustion back to the previous area of sensitivity. This was the previous area of resistance and the previous area of mini trend line. As we can see, the wick is pretty much touching this area zone, so you could have potentially waited for that to happen and entered the trade somewhere over here, straight away minimizing your risk and increasing your profit potential. Or you can aim just a tad bit lower to kind of get yourself in the market in the most favorable position and hopefully bank yourself a lot of pips. When trading with trend lines, you will definitely have this situation at some point in your trading career, so let's speak about it. So you might have a nice solid trend over here moving towards the upside happily, but you also have this area zone, right? And it's currently kind of squeezing. So what do we do? What do we wait for? As we can see, we broke out over here. Is it gonna go up? Well, I don't know. However, if we simply mark an area of resistance over here, as we can see previously, it has touched multiple times. 1 touch, 2 touch, 3, 4, 5, a lot, right? It's squeezing in between this trend line that we have. So trend over here, downtrend going down, and this area of resistance. So what do we have to wait for? Well, of course, we have to wait until this resistance line is broken and the trend is broken. Once both of these breaks happen, this is a favorable opportunity to enter the trade for a long position. So as we can see, we have a strong push towards the upside. What do you think happens after a push? Well, that's right, we're gonna have an exhaustion. So push, exhaustion back to where? To pretty much the previous area of sensitivity. Sometimes you're gonna have it till here, sometimes it's gonna be a little exhaustion if the trend is breaking out very strongly. So this is what you need to think about: support and resistance areas plus mini trend lines that we talked about earlier. Or you can use a couple of indicators to help you enhance your trading performance. So let's take a look. It's trending towards the downside clearly, right? However, if we add the 20 and 50 moving averages, it pretty much shows you an up-to-date trend, what's been happening. So as we can see, we can draw another trend over here. However, we don't need to, because we know that likely in between these two area zones, the market will continue moving down unless it breaks it. So this is our safe trend line zone that I like to call it, and this is my entry zone. So how would I enter over here? Simply, I would just enter short after a candlestick confirmation. So maybe a bearish engulfing candlestick bounce off that breakout would be great, or maybe just that shooting star over here, because I feel like the market could be continuing moving down since it's making new lows every single time. So the market moves with a push exhaustion scenario. As long as the push towards the downside is every time slightly lower or much lower, that's a good sign that the trend will continue down. So what we would do in this situation is not only cover our moving averages, but also cover pretty much the trend line over here and aim for, you know, an area zone where we can potentially bounce from. So around here, I would say. So if we just do this, 130 pips take profit level, 80 pips stop loss, that's 1.7 risk reward. And this upwards trend line is very usually near daily moving averages. If we just come to the daily time frame, as we can see, the 2 moving averages are here. So it's a great area zone for a nice strong resistance in case the 4-hour moving averages where we enter from actually break towards the upside. We cannot panic because we have a plan B. So this is our plan A for entry, but we have the plan B trend line over here saving our ass in case something happens. So let's just see whether this trade would have done well. And as we can see clearly, after that nice little upper shadow over here, similar to a pin bar, went towards the downside nicely. We didn't even need this trend, but you could have used this information to kind of know, even if it broke out these 2 moving averages, you had that kind of trend line over here. Maybe it went towards the upside, maybe it would have bounced off this area zone over here somewhere and then went towards the downside, saving your trade. Another thing about trend lines, sometimes you're gonna have this type of situation over here where the trend is moving towards the upside heavily, and then if you have the 2 moving averages open, you will see something like this. Typically a candlestick breaking the 50 moving average means that likely the trend will continue moving down. However, as we can see, the trend over here that we marked is still sitting at the bottom. So pretty much we can use use a very similar technique we did previously with the trend lines by waiting for a solid candlestick confirmation that shows bullish pressure. You never want to enter trade somewhere over here where the blue candlestick is not there, because there could be just too much pressure and it just goes towards the downside. You want to confirm that bullish pressure is there. This tells me bullish pressure is here, likely that this trend is very solid. So if we enter the trade over here, it could be a nice trading position. Yes, it plays about a little bit inside and outside of the moving averages, but at the same time the trend forms over here. We have our strong trend over here as well. But not only that, if we used probably the stochastic RSI, was telling us the market is oversold, and as we saw, the push actually happens. So using the stochastic RSI plus moving averages will give you much greater results.